Hello, and welcome to a new episode with your host, Vinnie Chopra. I'm so excited to have you here as we dive deep into the world of real estate investing, syndications, abundance mindset, and building generational wealth. We are excited to be in the top 1.5% of the real estate podcasts. Got number 11 actually out of top 50 real estate syndication podcasts. Thanks to you. Each episode, we bring powerful insights, expert guests, and actionable strategies to help you take your investing game to the next level. Whether you are a seasoned investor or just getting started, if you love what you hear, please take a moment to subscribe, leave a 5-star review, and follow me on social media so that we can never miss an episode. Your support helps us continue sharing valuable content with more people like you. Now let's jump into today's episode. Thank you. Hi there, guys. Vinnie Chopra here, back at you. Hey, thank you for making our podcast really one of the top in the 50s and 90s in USA for apartment syndications and all these different things. I've got a great friend today. Brother Ted Lanzaro is here. He's a highly recognized and respected certified public accountant, real estate investor, and real estate broker also. Congratulations. Yeah, Ted. And he's the founder of the Landmark CPA Group, LLC, located in Connecticut, a boutique CPA firm, but he specializes in all kind of accounting, taxation, and also the real estate industry, which is a huge part. Most of our followers are in real estate. For the past 35 years, he has helped thousands of real estate business owners and entrepreneurs for investors all over USA implement the cutting edge tax strategies and save them thousands of dollars annually on their taxes. So we are in for a big treat. Ted's new book is out there too, Year-Round Tax Planning for Real Estate Investors. Please get that on Amazon. Was released in December 2024. It's a comprehensive guide for proactive tax strategies for real estate investors of all types. Hi, Ted. How are you? How are you doing?
I'm good, Vinny. Oh my God, thank you for having me on. I'm doing great, man. Thank you.
Awesome. Let's start with the bang. What's the biggest legal tax saving mistake in real estate investors? They do it over and over again.
I think the biggest mistake that I see most investors making is waiting till after year end to address their tax situation. There's so much stuff that we can do during the year now for 2025 to help set people up to save money. That's the whole purpose of the book, Year-Round Tax Planning for Real Estate Investors, is to get people to start being a little bit more proactive about their tax strategy and really start thinking about, hey, I'm making some money. How am I before the end of the year? What things am I going to put into place? Do I have to buy another building? Do I need equipment? Do I start saving money to make a retirement plan contribution? All of these things that that you can do during the year. I can't buy a property in March next year to help me with my taxes this year. I have to do it during the year. So doing those things, that's the biggest mistake I see, not addressing it.
Awesome. And your book is amazing. And the thing is, there are lots of strategies, as you are saying, people need to look at in the year before December end, what you're saying. How about with the new big bill? Let's just talk about that. The cost segregation and the bonus depreciation. That's going to be a bonanza. Is that right?
Yeah, no, it really is, right? So think about this, right? But if we didn't get this, so now let's say, for example, you've got $1 million capital gain from a sale of a property that you need to get rid of. You didn't do a 1031 exchange. You're going to use bonus depreciation to get rid of it, right? Now, in order to do that, in the old scenario, you would have needed, with 40% bonus depreciation, you would have needed to buy something like a $10 million property in order to offset $1 million capital gain, because you would have taken that 10 million, you would have said, okay, I'm going to be able to reclassify about 25% of it, 2.5 million. 40% bonus depreciation is $1 million offset. Now I only need to buy a property for like maybe even 5 million would do it. 5 million, I get 25% of 5 million is $1,250,000. I get 100% of that. Now
Yeah.
I can cover, so a $4 million property would technically cover a $1 million capital gain instead of a $10 million property. And that's why it's so
Wow.
important. I'm able to go and tell people, hey, look, these gains that you want to offset or this income that you want to offset, now you don't have to try to find something so gigantic, right? You can buy something smaller and get the
Hmm.
exact same tax benefit.
I
That's
love
really
it. Love it.
yeah.
Would it also go down like it's 100% this year? Would next year it'll go down or it'll stay 100% or then 80,
It's
60?
100% now until they change it again. You're right.
Ah,
Perpetually 100%. Every
wow.
going forward until somebody passes the new tax law.
Wow. Wow. That's amazing. That's
It's
wonderful.
amazing.
Yeah. And I know the 1031 too, they were thinking it might get reduced or some stipulations, but they left that alone. We can do the 1031s and pass on the capital gains till eternity, kicking down the can, we call it.
Yeah. Yeah.
And it's
Yeah. Yeah. I've also heard it referred to as swap till you drop.
you know,
Because you can keep swapping
yes.
properties and the capital gains until you die. Swap till you
And when you die, it goes away. Is that right? That's what I
it goes
remember.
to yeah. If you give your properties to your children, they get a stepped up cost basis to whatever the market value is on the day you pass away.
Authentic.
Really, you can completely, literally, completely eliminate capital gains. Now, it's possible there's an estate tax, so
Yeah,
you have to
that's
watch
right.
out for
Yeah.
that. But the federal estate tax limit is
Yeah.
15 million now. That's
Yeah,
federal.
it's increased also, which is great
Yeah,
for husband and wife. Is that right? Like it's 30 total? That's what I understand,
I
right?
believe it's 30 total. Yes, 15
Yeah,
per.
30 total. Now, what's the smartest way to structure LLC for real estate business from the LLCs to S Corp, or do you promote that? Or what's a better way? Both give passive investors legally reduce taxes with that, or how?
Yeah, it depends on what business you're in, right?
Mm.
Okay. For rental properties, I always tell people to use regular LLCs or
Mhm.
LLC partnerships, right? What I like about LLC partnerships is a single member LLC ends up on your personal income tax return as
Yeah,
for a rental
right.
property. That's
Yeah,
business.
yeah.
A partnership return, so with the single member, all the details are on your Schedule E, every single expense item, blah, blah, blah. If you if you use a partnership, it goes on the partnership return, and then on your personal return, it's literally one net number. So partnership returns get audited less one in every 10,000.
I
It's
see.
like it's almost nothing. It's almost versus personal returns that get audited. You're about 6 times more likely to have your personal return audited than you are to have a partnership return audited. So
Hmm.
if you want to get aggressive with your
Hmm.
rental properties, then you want to use a partnership LLC. That's what I recommend typically, because it really reduces just that strategy reduces the audit risk.
Totally. Wonderful, wonderful. And we do syndications or fund managers. They have the LLCs and the equity from the investors' money is usually it's a pass-through entity, right? The
Right,
partnership. And then we
exactly.
give K1s to LPs and K1s to GPs. That's the
Correct.
structure. Yeah, which
Yeah.
I've been doing and it's been very beneficial.
Yeah, no, that's the best structure for that. Exactly.
Mm.
And then, for example, if you, let's say you were flipping houses, something
Mhm.
that's like an ordinary income kind of strategy, right? Or in your case, maybe it's the management company that goes with the senior living, the one that provides the
Yes.
services, right?
Yep.
Those might, because they're ordinary income type businesses, that's where you might want to use an S corporation.
I
You
see.
typically use LLCs for rentals and S corps for ordinary income trader businesses.
Beautiful. Beautiful. Thank you. Thank you for
Yeah.
that structure. And when we raise capital, we do syndications, right? So the critical tax considerations for GPs, they should be aware of early on. Any kind of light you could throw on that? Yeah.
Yeah, look, there's all different kinds of strategies. And for the GPs, they're typically going to be active, they're both active in the entity
Yeah.
and if
Active.
qualified, if they qualify as a real estate professional,
Professional. Yeah.
then they're going to be able to really use all of the benefits, all of the depreciation benefits of the syndication, right? Now, the limited partners, the passive investors, they've got a little
Yeah.
bit of a different situation. They can use the losses passed through on their K1 to offset net rental income from rental investments they have, either their
Yes.
rental
Mhm.
properties, or maybe they're in some other syndications that are throwing off rental income now.
Sure.
They can also use it to throw off or to deduct against capital gains from real estate. So let's say
Yeah.
I just got out of a syndication and it got sold and I've got a big gain. Now I can
Mhm.
use losses from a new syndication investment to offset the gain from my old syndication investment.
Yeah.
So it's like a ladder, right? You're basically using new investments to offset gains from old investments.
Excellent. And we can accumulate them too, right? If we don't have passive gains in a particular year, we can accumulate that negative K1, which I say losses,
Yeah.
negative. Yeah, the losses can be accumulated for how many years? I was told many years. Is that right?
It's basically unlimited. You're not gonna, in a syndication structure, your passive loss carryover isn't gonna die because you didn't get out of the syndication fast enough.
Yeah.
You're in for 5 or 7 years. So that's true. Your passive losses that you cannot deduct in the current year get
Carried over.
until one of two things happens. Either you have income to offset it,
Yeah.
right? Or the entity that you have the losses from is sold, at which
I
point
see.
you get to use the passive losses from the current deal,
Accumulated. I
the
see.
accumulated passive losses in the year of the sale of the property.
Oh, wonderful. So this is new to me. Oh, so when we sell, we could deduct that loss as a line item. Is that right? It will be like one
Correct.
of the, oh,
Yeah.
wow.
Let's say, for example, as a passive investor, I've accumulated $50,000 worth of losses I couldn't deduct.
Hmm.
Now you sell the property, and I get a K1 for $100,000 capital gain. Well, I only
Yes.
have to pay taxes on 50,000
Yes.
because I have the $100,000 gain, but I also have the $50,000 deduction that I haven't
Yes.
used. So now I'm net 50,000 on that, and I'm really
Beautiful.
happy because I made money.
Yeah. It's so true, so true. This is so exciting. In not stocks, you can't do it because if you lose, you just take out $3,000 for that year, as I recall. But in
Yeah,
leverage, in real estate, we are able to leverage with the loan, good debt, we call it, right, with the bank. And the appreciation, the bank doesn't want any of the appreciation. They want their balance of the loan back. That's it. And GPs and LPs share the profits or the gains, capital gains, we call it, but then you're able to reduce that impact with the negative that you have gotten over the years and carry forward. Very nice. Thank you. Thank you so much. You
yeah,
know,
yeah.
what other like ways we could do it? I know when we give distributions in the quarterly distribution or monthly distributions, this is return on capital. Is that right? And returns off capital is when we give the principal back. What's the best way? What's the best way? I was trying to.
I think the best way, if I'm a limited partner, I'm a passive investor, right? I want returns of capital, returns
Yes,
on capital. I want returns on capital because that
on
means you're
capital.
making money, right?
Yeah,
I mean, a
exactly.
return on capital is cash flow from the
The,
profitable operations of the business.
yes,
And that's what I want. I want my money back at the end,
yeah,
but I
yes,
want to have return on capital during the life of the syndication. I want to know that
yes.
the entity, the hotel or the senior living or the whatever,
Mhm.
it's profitable, it's producing net income that's then shared across the capital stack, the investors that invested in it. We're
Yeah,
a piece of the cash flow. And what's
distribution.
nice,
Yeah.
yeah, the
Mhm.
distribution. And what's nice about that is I can actually put cash in my pocket every year,
Yeah.
and I still have a small loss on my K1, which means I don't
Yes.
pay taxes on that cash. I got the cash. That's the whole idea of why you would want to be a passive investor, is to get
Yes.
tax-free cash flow.
Yeah. I agree 1000%. So in their K1, because of this P&L on the property. It made all the profit for that year, and the investors got LPs, limited partners or partners. If we do it the other way, they get that distribution of the dividend or cash flow, but the line item of accelerated depreciation, cost segregation, or regular depreciation, mine, it's a paper loss. It's totally a paper
Right.
loss, which makes
Yeah.
the whole P&L go negative at the bottom for taxation. Huh?
Yeah, exactly. And that's the real benefit. It's really a cool concept if you think about it. And that's why passive investors should be investing in syndicated deals, is for the tax-free cash flow.
Yeah.
And because it's a great deal. If I'm investing with you, it's because I think you're going to operate it profitably, and then you're
Yes.
going to sell it for a profit, and I'm going to make money. And
Yeah,
that's even if
exactly.
I can use the tax benefit, is really like the cherry on the top of the ice cream
Definitely.
sundae.
Yeah.
And it's the cash flow that the tax-free cash flow that I'm really looking for.
I love it. Love it. Now, for the retirement funds, right, Ted, they are already got that inherently built in it, self-directed IRAs, 401ks, all these plans, SDIR, right? We call it
Mhm.
self-directed. So they are not paying taxes anyway because it's within that entity. So we don't have to show the K1. Is it also possible? I found out somewhere they said that the GPs can give the depreciation a little bit more to certain members, and the IRA investors can elect, they say elect, to give up their negative depreciation to other members in that LLC. Is that true? I just wanted to ask you that.
Yeah, you're allowed in an LLC, you're allowed to allocate losses in any way you want to, right?
Ah,
So if you
yes.
have a group of retirement plans, so what I typically advise people to do is to set up a separate membership class
Okay. Yes.
for those people, and,
Uh-huh.
and you tell them up front, hey, IRA investors are not
Mhm.
going to share in accelerated depreciation, but you're going to get whatever else you're giving them for that,
Yeah.
right? Maybe
Yeah.
they get a slightly bigger pref, or they get
Yeah.
something else.
Right.
And so with those kind of benefits, right? That's where you set up a separate class of membership interest for those people. And then you're able to allocate the rest of the depreciation any way you want. And correspondingly, on the back end, they don't get any of the recapture of the depreciation because they never got any of the depreciation in the first place.
In the first place. Yeah.
What you end up with then with those people is you end up with what they end up ultimately, their ultimate gain is basically a cash on cash return. I put in
Yeah.
$100,000. I got $5,000 a year for
Mhm.
5 years, and then I got $100,000, my $100,000 back at the end. Plus maybe I got $150,000 back at the end, whatever it
Right.
was. I put in
Yes.
100. I put in 100. I got back 175. I've got a $75,000 gain within my.
Yep.
And then depending on what kind of retirement plan it is, that gain might be subject to a UBIT tax, right?
Yes.
So that's important to know. I believe it's IRAs that are subject to UBIT tax and 401ks that are not, if I remember
Yeah.
correctly. But as an IRA investor, I would love to pay UBIT. And the reason I would love to pay UBIT is that means I made money.
Yeah.
Hi friends, this is Vinnie Chopra from here in Danville, California. And you might be saying, hey Vinnie, what are these over here? You know, I wrote this book a few years back. Apartment syndication made easy. It became top seller. I came from India with $7 in my pocket. It says 500 million. It's going to be 1 billion very soon, very soon. I'm right at about 850, 900 million. And then I'm ready for the next billion. Actually, you will see that happening. 2 billion in this book also. The other book I wrote, which has been a very big positivity, has been my life. Always, I've been married 43 years with 2 children, and the beauty is to be positive, the mindset that can take you to all the places in the world. And that's the book that also became big seller. My third book, Senior Assisted Living, is coming. So do yourself a favor. Go ahead and click the link below to get free copies, audio copies of these books, even printed copies of these books. If you, printed means digital, if you can't afford it. But I would highly recommend for you to get these, or go to Amazon.com. Just go to Amazon. I got it in soft cover, in hardcover, in Kindle, in audio, also the Spanish version of this book also. So let's crush it, guys. I know you can be successful. I know you can do the kind of things that you want to do in life and have the streams of income and know how to really, educate yourself so that you could become a strong force in this world in real estate. I know you can. So take that step. Don't just be on the sideline. Take charge of your life. Take charge of your education.
You know what I mean?
That's right. That's right.
If I put in 100 and I got none back, I don't have to pay any UBIT, but I lost $100,000.
Yeah,
If I put in 100 and I get 175 back and I made 75 more, I'm happy to give some of it to the government because I made money.
Yeah.
People should look at it like that. That's a grand slam strategy because you're not gonna pay any of the taxes in between, right?
Totally. And when they start taking it out at 62 and a half, I think is the age, at regular increments, they don't pay any penalties either. If they do withdraw, that's a 10% penalty or something. Is that right? If they withdraw more than
early. If you withdraw before you're 55, I believe, right?
55. Okay, 55, not 62 and a half. Okay. Yeah,
but if you keep it in and you withdraw during your retirement, not only don't you have a 10% penalty, but you can then structure, again, it depends on how much of the money you actually need to live on.
Yeah.
But you can structure it. So we do this all the time with some of our older clients. We tell them, look, you can deduct, or you can take up to $40,000 this year without going to the next bracket. You know what I'm saying? Like if you're in the 15% bracket, you can take $40,000. If you take $50,000, 10 of it is going to be in the next bracket, maybe the 20% bracket. So we tell them how to keep it all in the lowest bracket so that they distribute it out to themselves at the least possible tax.
I love it. I love it. I'm so glad. Thank you so much. And hi, guys. I hope you're really liking all these great golden nuggets from Ted. And please like us, give us 5-star reviews, give a great comment on iTunes or like that. So, Ted, any other things we should talk about with the changes, with the new big tax bill that you can think of? Yeah,
it really comes back to using all of these things. As using everything that they gave us, everything we had, and everything that they gave us proactively during the year. It really comes back to that whole concept of the year-round planning. But some of the other things that are cool are, like, you live in California, I live in Connecticut. Neither one of us have been able to deduct our state income tax, right? At $10,000 a year. Now that new limit is $40,000.
40,000. I read that.
That makes a big difference. When it first passed back in 2017, they were calling it tax cut. I didn't get a tax cut. My tax bill went up because I lost. I lost all of my property taxes and my state income tax that I lost about a $45,000 deduction. So my taxes went up. But those are the kind of things where you have to look at that. I really like the extension of the opportunity zones. That's going to be very important. Even though that doesn't really go into effect until 2027, right? It's just another tool that you're going to be able to use starting in 2027. You're going to be able to use that opportunity zone strategy to offset not only capital gains from real estate, but capital gains from everything. So if you have a big stock capital gain, you sell your company and you have a capital gain. Whatever you're doing, you have a big capital gain, you can use that opportunity zone strategy to be able to defer the taxes for, I think it's 6 or 7 years. It's an extension.
Wow. So why did they do it in 2027? They want investors, developers to really seek out and see the zones are already determined, or they will be new zones, opportunity zones.
I think they did it. I think without being able
Uh-huh.
to read the mind of Congress. I think they did it
Yeah.
because the current opportunity zone rules expire in 2026. And
Okay.
and I believe they are actually redrawing some of the
Then,
maps.
mhm,
More opportunity zones. They are narrowing, from what I read, they're narrowing the restrictions,
I
and there's
see.
going to be more opportunity zone areas for people to choose from, right?
Yeah.
So I think that's one of the reasons they did it. They needed time to redraw the map.
Got it. Makes sense. Makes sense. Any other things come to your mind as the investors, the LPs, the GPs? We covered a lot in this, and I hope
Yeah.
people can go back. And then the biggest thing is the cost segregation, which is amazing. Accelerated depreciation, we call it, to get the negative passive income or active income can really help a lot, really, in planning and getting new opportunities, new investments, and that way everybody's benefiting. Yeah.
Yeah, and one of the bigger things that I've been talking to people about these days is the concept of short-term rentals, right?
Yes. Oh,
Using
please.
short-term rentals, you can bypass the real estate professional and passive activity loss rules. And if you,
Yes.
let's say I'm a tech person and I can't qualify as a real estate professional, but I can buy short-term rentals, and there's a
Mhm.
certain set of rules. You either have to run it, you have to provide services like you would in a hotel, or you could keep the rentals under 7 days. That's another one of the
Mhm.
exemptions. And if you do that, then you don't, it's not really a rental property. You don't report it on Schedule E of your personal
Mhm.
return. You report it on Schedule C.
See.
And that allows you to take the depreciation deductions
Yes.
against your ordinary income. And I
Yeah.
really like this. I like this strategy as a combo for these kind of investors, these high income investors who would normally be like the people in your syndications, for example.
Yes.
Really like this strategy because it works hand in hand with the syndications. Right?
Mm.
Because after I get the first year loss on one of these single short-term rentals, the following
Mhm.
year I'm probably making money. I can use the losses from the syndications
Yeah.
potentially to offset my rental income, because now maybe it becomes a long-term rent. So maybe because a short-term rental, you don't necessarily, you can qualify the first year and the second year, but maybe the third year, maybe things start to come down a little bit. You're not getting as much
Mhm.
activity. You put somebody in there for a whole year. Now
Yeah.
you don't qualify for the short-term rental exemption. You have to go back to Schedule E, but I can use my syndication losses to offset the net rental income.
I love it. I
Right?
love it. This
You
is
know,
so great you mentioned. Yeah. Uh-huh.
yeah, and this is the kind of like long term. This is why when we talk about year-round tax planning,
Mm.
talking about it in the term not only for the current year, but as a long term. I'm typically doing 3 to 5 year tax plans for my clients.
Yeah.
So that we're
Mhm.
looking out now. We're using estimates, obviously, because we don't have actual information, but
Sure.
that long-term view really helps people save.
Lots of money, lots of money. Let's
Mm,
talk about hospitality also, hotels. I know
yeah.
that's something, it's a daily business, I've heard, right? Daily activities because the rents are there, tourism is going. Yeah. So, how does that? I know 179, for example, like this Marriott we are buying in Plano, Texas, we are buying it at 14.5 million. Buying cost, replacement
Mm,
value is 24 million. What? And now we are putting 4 billion into it. That will be
mm.
about 18, 20 million total with the loan and all. So that is going to be deductible, lots of depreciation, isn't it? Wow.
Yeah, yeah, because not only do you have the building, right, that you're
Hmm?
depreciating, but think
Yes.
about, what does a hotel have in it? It has, if it's a 100-room hotel, it's got 100 bathrooms. It's got closets. It's got a whole bunch of cost segregated items. Plus, it's
Yes.
got beds,
Yep.
furniture, all of this stuff, common area,
Yep.
things that so there's all kinds of stuff that gets either cost segregated as if it's built part of the building, or is just regular old 5 and 7 year assets. If it's furniture, lighting,
Mhm.
all of this stuff is all subject to Section 179 depreciation on a hotel, right? So yeah, a hotel for these, I even tell my passive people, hey, get together, get 3 or 4 of your buddies and buy a small hotel.
Exactly.
Because put somebody in charge of running it. And it's an active business. You can't, it's not passive, but it's an asset heavy investment that you're going to get a lot of depreciation on. And assuming that you can put somebody in charge of running it that's a professional to do it,
Yes.
and you can still stay active. It's a good way for high income people who don't qualify as real estate professionals to save,
Get the benefit. Get the
reduce their
benefit
money,
of
right?
it. Totally.
They
Now
wouldn't be
we
buying
have.
something as big like you're buying, right? They're not buying
Yeah.
a huge hotel, but even a small 12-room hotel on the side of the
Yeah.
road kind of place. No, seriously, could make a nice investment for somebody who just wants to use the depreciation to offset their income.
Totally. Now, also in this Marriott courtyard, we are converting it from generation two, which was 1998. It was built 27 years back, to now 2025. Everything will be ripped out, and then new everything will be put, and structural changes, few things, and all that. But that is going to be generation six. Now, is it true that we could take out the furniture we throw away? We can also deduct or something? It's somehow, I'm trying to
Yeah,
remember when we throw some things out and bring the new things in.
this is a great strategy because it's like a double whammy, right?
Yeah,
Double whammy. I just made that term up, right? There's nothing in tax code about a double whammy. But here's
yeah,
what ends up
yeah.
happening, right? So you buy this property, right?
Yes,
You're
yes.
going to allocate you bought everything that was in it,
Everything,
okay?
all the furniture, all everything, Ted, everything. And we're going to
Right?
uproot that out and put new generation six furniture and everything in it. Yeah, share with me. Yeah. Uh-huh.
So part of the original purchase gets
Yeah,
allocated to all of those things. Not
totally.
only
Yeah.
does it get allocated to all of the furniture and stuff, but it gets allocated to all of the stuff in the rooms. If you had to take out all the toilets, just as an example.
Yes,
Okay.
yes.
So now maybe you have on the building, for the building piece, you might have a cost segregation company come in before you start renovating and tell them,
Correct,
this
correct.
is what we're going to do. And then they
Mhm.
estimate the cost of everything in that building that you're going to throw away.
Okay.
It's called a disposition study.
Disposition of all the furniture in this Marriott
Right.
courtyard, Ted, and then that will be allocated. How would we get tax rebate on that?
So what ends up happening is, what did you pay for it? 14 million?
14 million five total. So land will
Okay.
be, let's say, 20%. Rest is 11 million left, or 12 million, whatever.
Let's
So
say of that 14 million, $1.5 million was allocated to the furniture and everything.
furniture, yeah, million and a half.
So now
Yeah.
you're going to get, once you do that, you're going to get $1.5 million loss that you
Okay.
can pass through to
Okay.
everyone.
Oh, 1.5 million lost right away. Yeah, because we are
Right away.
taking out the furniture. Yeah, yeah.
Assuming you do it in the year you purchase it, you put it right
Yeah,
on.
this year,
Okay.
2025,
Yeah.
right now. Yeah.
Yeah, what's cool about that is everybody gets to take the loss. There's no passive loss rules, none of that. Everything that's disposed of is what's called a 1231 loss, and you're able to take it even if you don't
Okay.
qualify as a real estate professional.
Wow. Oh, wow.
Now you go put everything back in. You put all the new stuff in, right?
Yes, all
Here's
brand
where
new.
it gets even better. Now you get the new stuff in, right? Now you do a cost segregation study afterwards, and they
Yes.
tell you what is the cost segregated value of all the new improvements you've made to the hotel.
Yes.
And then you still get to take the 179 on all the new furniture.
Exactly.
All of
Yeah.
that, right? So it's not only
Yes.
the stuff that's fixed to the room, like the tubs and the showers and
Mhm.
the tubs and the vanities and all that. It's all of the furniture that the things you can actually remove, the lamps and the dressers and whatever. So you get the disposition loss, and then you get the depreciation on all the new stuff. That's the double whammy.
I love it. Love it. Oh my gosh.
Yeah.
This is so exciting. So exciting. I know we went over time, but thank you so much, Ted. How can people reach you? Wow, you have given so much knowledge.
Yeah, you can reach me via email at ted@landmarkcpagroup.com.
Okay.
You can go to my website, which is www.landmarkcpagroup.com.
CPA. Group.com.
And you can also get a copy of my book there. You can download a copy of my book.
Yeah. Oh,
for free.
nice.
You don't have to, you don't have to buy it. And then if you go to the website, my phone number is on there, and you can call my office or whatever, and or you can, even on the website, you can make an appointment to talk to me about your unique situation. So there's a lot of different ways to do it. I don't have a preference really.
I love it. Ted, thank you so much for joining me today. It's such a pleasure to have you back. And guys, if you really got a lot of good stuff, please share this episode with your family, friends, contacts, everybody. And we'll see you in the next episode. This is Vinnie Chopra signing off. Thank you, Ted.
Dear friends, this is Vinnie Smile Chopra. I am so glad you're listening to the episode. Thanks so much. Really appreciate that. Please share it with others who can really benefit also. Can I ask you a favor? Just a small favor. Less than a minute, if you could give 5-star reviews on iTunes or Stitcher, that'll go a long way. We are one of the top podcasts in real estate now in the nation, but it will really help a lot if you gave 5-star reviews, and we'll bring a lot more great content for you. Thank you so much. Appreciate that, and see you in the next episode. God bless you. Bye-bye. Wow, what an incredible conversation today. I hope you got tons of value from this episode. If you did, don't forget to subscribe, leave a 5-star review, and follow me on social media to stay updated on all the things real estate, investing, abundance mindset, and wealth creation. If you're an accredited investor looking for exclusive investment opportunities, be sure to join our elite Monil Investors Club at vinniechopra.com/invest, where we share details of our future projects. Quick disclaimer, we are not selling any securities, and this podcast is strictly for educational and information purposes only. The opinions shared by our guests are their own and should not be considered financial or investment advice. Always do your own due diligence and consult with a financial professional before making any investment decisions. Thank you again for tuning in. Until next time, keep smiling, keep investing, and keep making a massive impact. God bless you.
Be sure to listen to Mr. Smiles next week with more golden nuggets and top-notch coaching tips. You can reach him by going to vinniechopra.com. Be sure to like, comment, and share to show everyone how Mr. Smiles has brought your apartment syndication business to the next level.